Imagine investing $100 a month into the S&P 500. What do you think that could turn into over 35 years? Most people guess not much, because $100 feels small. But when you combine consistency with time, the numbers can get surprisingly big. In this video, I'm going to keep it simple and easy to follow. No complicated formulas, just clear steps you can track. We'll cover 3 things. First, how much money you actually contribute. Second, what compounding can do over decades. And third, why the last 10 years often create the biggest jump in returns. Quick note, this is educational, not financial advice. The market can go down, future returns are not guaranteed, but the math of long-term compounding is real. And once you see it clearly, $100 a month won't feel small anymore. Alright, let's start with the baseline. $100 a month is about $25 a week. It's roughly $3 a day. Not nothing, but also not, you need a huge salary first, money. Now here's the key question. If you invest $100 per month for 35 years, how much do you put in? $100 times 12 months is $1,200 per year. $1,200 times 35 years is $42,000 total. So if you did nothing but save that cash, you would end with $42,000. That is our starting point. That is what saving alone can do. Investing is simply giving that same $42,000 a chance to grow. Now, what are we investing in? The S&P 500 is a collection of about 500 large United States companies. When people say the stock market, they often mean something like this, because it represents a broad slice of the United States economy. The advantage is simple. You are not betting on one company. You are spreading out across many industries. Technology, healthcare, finance, consumer brands, and more. For this video, picture a straightforward setup. You buy an S&P 500 index fund, and you invest $100 automatically every month. No day trading, no guessing, no trying to time the market, just a steady habit. And this works because compounding does not reward intensity, it rewards time. So let's explain compounding in the simplest way possible. Compounding is when your money earns returns, and then those returns earn returns too. In the beginning, it barely looks like anything is happening. That's the frustrating part. Your balance is small, so even a good percentage return does not move the needle much. But over time, the same percentage return applies to a larger and larger balance. That's when the curve starts to lift. A helpful way to think about it is a snowball. At first, it's tiny. You roll it a little. It grows a little. Nothing impressive. But as it gets bigger, every roll collects more snow, and eventually it starts growing fast. That is why people who quit early never feel compounding. They stop before the snowball is big enough to roll on its own. So if you're new and your account only grows a little at first, you're not doing it wrong. You're just early. Now, one more reality check before we do the numbers. The market does not rise smoothly. Some years are great. Some years are rough. Some years are flat and boring. That volatility is normal, and it's also why short-term investing feels stressful. Long-term investing is different. It's trying to capture the big picture. Over long periods, markets have tended to rise as businesses grow and the economy expands. To estimate what might happen over 35 years, we need a return assumption. Historically, the S&P 500 has averaged around 10% per year over very long periods, when dividends are reinvested. That does not mean it will do that in the future, and it definitely does not mean it does it every year. But using 10% as a long-term example helps us understand compounding. Then we'll also look at more conservative scenarios, like 7% and 5%. Alright, here are the milestones. This is $100 per month, invested for 35 years, using a 10% average annual return. At about 5 years, you've put in $6,000, and your account value is roughly $7,800. At 10 years, you've put in $12,000, and your account value is roughly $20,500. At 20 years, you've put in $24,000, and your account value is roughly $75,800. And at 35 years, you've put in $42,000, and your account value is roughly $379,000. Now here's the part I want you to really feel. Compounding accelerates. Early on, most of your balance is contributions. Later on, most of your balance is growth. Look at the decades. Around year 10, you're near 20,000. Around year 20, you're near 76,000. Around year 30, you're near 226,000. And by year 35, you're near 379,000. The jumps get bigger because the balance gets bigger. That is the compounding curve. So if the early years feel slow, that is normal. You are building the base. Now let's zoom in on the part that surprises almost everyone. The last 10 years. At around year 25, the balance is roughly $132,600. At year 35, it's roughly $379,000. So the last 10 years added about $246,000. Now here's the punchline. How much did you contribute in those last 10 years? $100 a month for 10 years is $12,000 in deposits. So you put in about $12,000 and the account grew by roughly $250,000. Not because the market was easy, because the account was finally big enough for compounding to show its full power. This is why time is such a cheat code. Not because it is guaranteed, not because it is always smooth, but because once the snowball gets large, even normal growth adds up fast. Now let's make this even clearer with a simple story. Imagine two friends, Alex and Jordan. Alex starts investing $100 a month at age 25 and stays consistent for 35 years. Jordan waits 10 years. Jordan says, "I'll start later when I make more." So Jordan starts at 35 and invests $100 a month for 25 years. Same habit, same index fund, same monthly amount. But the results are very different. Because of time. In our 10% example, Alex ends around $379,000. Jordan ends around $132,600. Jordan did not just miss 10 years of deposits. Jordan missed 10 years of compounding. And those years tend to be the most powerful years. That is why start small and start now works. You do not need perfection. You need time. Now, let's be conservative for a minute. What happens if the average return is lower? At around 7%, $100 per month for 35 years becomes roughly $180,000. At around 5%, it becomes roughly $114,000. And in all cases, remember this. You contributed $42,000 total. So even in conservative scenarios, your money is still doing meaningful work over decades. This is also where inflation matters. A dollar in the future will not buy what it buys today. That is one reason people invest. They are trying to grow purchasing power over time, not just stack cash. So the takeaway is this. Small deposits, plus a long time horizon, can create a serious result. Now, let's talk about the hardest part, behavior. The market will drop sometimes. That is not a maybe, it is guaranteed. And when it drops, most people feel like they should stop, because stopping feels safer. But if you are investing monthly, a drop can actually help you in one specific way. Your $100 buys more shares when prices are lower. That is the idea behind dollar cost averaging. You buy consistently through good markets and bad markets, and over time you smooth out the chaos. And the easiest way to stick with this is automation. Set it up so $100 goes in every month, whether you feel confident or not. Time and consistency matter. This is not about being perfect. It is not about predicting the next crash, timing the bottom, or picking the next hot stock. It is about building a calm, repeatable habit and giving it enough time to work. Thanks for watching, and remember, small steps, repeated, become big results.